every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to Money Talk for the final time this week. It's Friday the 10th of May and today's top business, finance and economic stories from around Asia are coming up. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's headlines, the Bank of England signalled it will cut interest rates this summer if inflation stays low, even as it kept borrowing costs at a 16-year high of 5.25%. BOE Governor Andrew Bailey told a press conference on Thursday that we need to see more evidence that inflation will stay low before we can cut interest rates, but he was optimistic that things are moving in the right direction. But Mr Bailey warned a cut wasn't a fait accompli and it's not a done deal, he said. Traders currently expect the BOE to make two 25 basis point cuts by December. US jobless claims last week reached their highest level since August, raising expectations that the Fed might cut interest rates at some point this year. Initial jobless claims unexpectedly soared to an 8-month high, offering further evidence that the labour market is softening. The number of people claiming unemployment benefits in the US surged by 22,000 to 231,000 in the week ending May the 4th. That's the highest since August 2023 and sharply above economists' expectations. The high reading halted the streak of 4 consecutive downside surprises. China's exports edged higher in dollar terms in April as Beijing pins its hopes on a manufacturing-led revival to boost the world's second biggest economy. The value of exports from China advanced 1.5% year-on-year to a 3-month high in April, rebounding from a 7.5% drop in March when lower prices hurt Chinese producers. And the value of imports to China rose by a bigger than expected 8.4% year-on-year and reversing from a 1.9% fall in the prior month. It was the first rise in purchases for 3 months as domestic demand strengthens due to improving economic conditions. President Xi Jinping hailed Hungary as one of Beijing's most important strategic partners during the final leg of a 5-day tour of Europe to promote his country's potential as a trade partner. President Xi spent Thursday in Hungary after visiting France and Serbia during his first trip to Europe in 5 years. China and Hungary have upgraded their relationship to an all-weather, comprehensive strategic partnership for the new era, President Xi told journalists. Our bilateral relationship is at the best it has ever been in our history, President Xi said. On today's programme, we have with us Francis Lun, the CEO of GEO Securities, and Karine Hirn, Partner and Chief Sustainability Officer at East Capital Group. With a view from Australia is Toby Lawson, the CEO of Statton Partners. And today's Asia Business newsletter is up on my website. Please take a look at it at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks rose, advancing in a broad rally after data showed signs of softening in the domestic labour market. The Dow extended its winning streak to a 7th day. The Dow jumped 331 points, or 0.9%, to close at 39,388 and notch its longest winning streak since a 9-day run in December. The S&P 500 closed 0.5% higher at a 5-week high at 5,214. The benchmark index is less than 1% away now from its all-time high. The tech-heavy Nasdaq Composite advanced 0.33% to 16,346 as 4 of the Magnificent 7 stocks made gains yesterday. All 3 major indices are up at least 3.5% in May. That's after falling in April. And the small-cap focused Russell 2000 also finished at its highest level in a month after closing 0.9% higher. US Treasuries were also helped by the soft labour market data and an auction of 30-year US government bonds, which was met with solid demand. The yield on the 2-year notes was down 3 basis points at 4.81%, while that on the 10-year was down 2 basis points at 4.46%. The dollar was sold, with the US dollar index slipping 0.33%. Asian currencies continued their slide as a stream of Fed officials warned that US interest rates would need to remain higher for longer. The South Korean won weakened 0.2% against the dollar to 1,368 won. The Japanese yen fell 0.1% against the dollar to 155.57, even as officials resumed warnings about the currency's weakness. And in Shanghai, the Chinese yuan was up 0.1% at 7.22 renminbi per dollar. The softer dollar saw commodities all trade firmer, particularly metals, with spot gold up 1.6% to $2,346 an ounce. Brent crude oil settled 0.4% higher at $83.88 a barrel. And cryptocurrencies were also bid today as the dollar sank. A small net inflow into ETFs yesterday supported Bitcoin. It was up 1.7% at $62,720. And equities in Hong Kong and mainland China rose on Thursday following better than expected Chinese trade data. The Hang Seng Index added 224 points, or 1.2%, to a near 8-month high of 18,538. On the mainland, the Shanghai Composite Index climbed 0.8% to 3,154. Futures markets pointing to a gain of about 100 points for the Hang Seng at the open, projected to start at around 18,640. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's a Friday morning. I know that because I can see Francis Lun, the CEO of GEO Securities, sitting opposite me. Morning, Francis.
Hi, good morning.
And also joining us is Karine Hirn, partner and chief sustainability officer at East Capital Group. Always good to see you, Karine. Good morning.
Good morning.
Let's start with some Chinese trade data, shall we?
Yeah.
China's exports edged higher in dollar terms in April as Beijing pins its hopes on a manufacturing-led revival to try and boost the world's second biggest economy. The value of exports from China advanced 1.5% year-on-year to a 3-month high. That's rebounding from a 7.5% drop in March when lower prices battered Chinese producers. The figure beat economists' forecasts of 1% growth. By export product, automobiles continue to see stronger growth amid China's strong competitiveness in the NEV sector. They were up 21.2% year-on-year, and the volume of exports of steel products rose 27% in the year through April, although prices continued to fall, with the value of those shipments down 13%. And it's worth noting that countries from Europe to emerging economies like Brazil and Turkey have started probes into claims of Chinese dumping of steel. The value of imports to China rose by 8.4% from the prior year. That was ahead of analysts' forecasts of 5.4%, and it also reverses from a 1.9% fall in March. That was the first rise in imports for 3 months as domestic demand strengthened. And China's imports from the US, they climbed by 9% in April from a year ago, while exports dropped by 3%. The US remains China's largest trading partner on a single country basis, while the ASEAN nations are China's largest trading partner on a regional basis. China's exports to ASEAN rose by 8% in April from a year ago, while imports rose by 5%. Francis, some familiar themes there, aren't they?
Yeah.
First of all, the importance of the Asian nations seem to be growing for China, and then also strength in these sectors that President Xi wants to promote, like electric vehicles.
Yeah, actually, the export electric vehicle was a recent event. Actually, really started big in 2023, and then it carried on to 2024. And I think exports of EVs will grow more than 20% this year. And concerning the growth in trade with ASEAN, basically it is because some of the Chinese factories have relocated to ASEAN countries. That's why some of the trade increased. And maybe I think U.S. trade fell a little bit. But if you count the transshipment via ASEAN and even now Mexico, and then you see the Chinese products still dominate the import of American industrial goods.
Interesting that the trade data, it broke out the data for quite a lot of countries, but didn't do it for Mexico.
That is an oversight.
Oh, I'm sure it was. Karine, what do you read into this?
Yeah, no, it's definitely a confirmation of the trend that we've seen already for quite some time, and clearly here the Chinese reading very well what's going on in terms of current geopolitical tensions and probably upcoming geopolitical tensions, making sure that they are shifting part of their manufacturing capabilities or reassembling or assembling capabilities to markets where from it is easier to export to some other markets. But it is probably not going to be possible forever. I think increasingly we're seeing both in the US and in Europe, which are major markets for Chinese companies, some increasing scrutiny in terms of investigating where that is actually come from, and this with a number. I mean, as a chief sustainability officer of his capital group, this is a theme that we are discussing quite a lot, because it is, for instance, you have regulations in Europe that has been recently passed called the CS Triple D, where basically companies need to do due diligence on their value chain, and the value chain and the supply chain it can be put as like going very far into it, so to say, and investigating where everything is being made comes from, and any environmental and social characteristics and risk around this. So, yeah, no, definitely very interesting number, and I think it was also kind of a little bit higher than we're expected, which also gets the investors in general to feel a little bit more positive about the Chinese market, and that has been welcome, so to say.
Did you, Francis, see anything in these numbers that may lead you to think that the trade tensions might ease a little bit, or not?
I doubt it. I don't think so, because America accused China of dumping products like steel, solar panels, and of course electric cars. And actually, electrical vehicles have been kept out of the U.S. market. If they were allowed, it will flood the U.S. market, and the big three will suffer enormously, I think.
What about the rise in imports? That was a little bit unexpected, wasn't it? Is that a good sign? Is it showing that maybe domestic demand is coming back?
No, but you have to see what are the contents of the imports. It's mainly intermediate goods like computer chips and things like that. So they will be made into cell phones and electrical appliances, and then we export it. So that really shows that the export business is growing. So this trade data is really a good sign for the Chinese economy, because the economy has been in the doldrum for the past 3 years, and now we really see a sign of growth.
If you break the imports down into categories, again, it's familiar themes. It was concentrated really in just a few categories. The most notable one was things to do with AI. Data processing equipment imports were up 50% year on year. Integrated circuits up 12% year on year. All the things to do with high technology, AI. That tends to suggest, doesn't it, that this is clearly one of the main themes of China's trade policy and economic policy, to be able to compete in the global AI race.
I think that also shows China's vulnerability, because it depends on suppliers in the U.S., Japan, and Europe. For a lot of the high technology products, it doesn't have the capability to build state-of-the-art chips and things like that. So it is still very vulnerable to overseas trade sanctions.
It was interesting, wasn't it? We heard earlier this week that the US is thinking about now placing restrictions on US companies' exports of AI to China, not just the chips that drive it all, but the actual sort of software and the generative AI processes. I'm not quite sure how they're going to be able to do that, but nevertheless, the fact that they're thinking about it tells you something, doesn't it?
Yeah, and it's completely, I think, the whole concept of, what do you use your imports for? What do you use any goods or services for? And I think here what we see clearly as the theme emerging is the risk that a lot of countries see around what's going on in China in terms of technological innovation, which is absolutely staggering, and in what way this could be filling basically some risk for security. And in this conversation, of course, then we cannot ignore the topic of China potentially supporting one way or another, directly or indirectly, Russia. So you have all these issues related really to the what can AI be used for, which is very tricky indeed.
What do you make of the data for Europe? China's exports to the EU fell about 3.5%, while imports rose by nearly 2.5%. President Xi is in Europe at the moment, or just finishing his trip to Europe to promote China as a trade partner. Is he succeeding?
Well, look, I think it was a very important trip, and it was the first time in 5 years. And first going to France and China have a very specific calendar year now, celebration of their recognition of, establishment of diplomatic relations. Of course, you've got the Olympic Games coming up as well, which and China has been very supportive. So it was important and interesting that he started by going to France, also not only meeting with President Macron, but also von der Leyen, the head of the EU, at a time when we have, the elections in the EU elections coming next month. So what I think, let's see first. He's still there. So he went, as you probably talked about in the show. First went to Serbia, and now is in Hungary, and up until later today. Of course, a lot of people specifically mentioning, how come he's going first to France and then, first France and not going to Germany, for instance, but then going to Serbia and Hungary. And I'm sure we're going to talk a little bit later more about that. But it's of course in a situation where the Chinese domestic consumption is fairly weak. We still have to go through this painful crisis in the real estate market. The export market is very key, I think, for China. And even though actually what is interesting, if you think about in terms of statistics, China is an export power, of course. Today, actually, 35% only of Chinese exports go to developed economies, and 65% go to the rest of the world. Even if you take into consideration the fact that you have some re-exports, i.e., for instance, you send, as we were discussing with Francis earlier today, about the fact that you export to Vietnam or Mexico, and then it goes on. Even if you do an adjustment here, it's still basically 60% of global consumption. 60% is going to these developed economies, developing economies. So my point is saying is that it's actually for China, the export to rest of the world is bigger, but if you look at it, developed economies still represent the largest part of global consumption. So they cannot just miss it at the time when they already are being challenged domestically. So it is really key for I think for President Xi to make sure that their export champions do not get more markets closed for them.
Do you think France's President Xi managed to allay the EU's fears over overproduction? That he denies it, doesn't he? He says there isn't an overproduction problem. So I suppose that suggests he hasn't allayed their fears. But what do you think?
Well, I think he failed. Nobody believed that. But if you look at the industrial production in China, there is overproduction in every single product and every single market, and especially housing, of course. You have oversupply of flats that cannot be sold. And then the problem is that this is not a market economy. And every province, every city, they try to build up the credentials for promotion. They invest in these big industrial products like steel mills, electric vehicles, etc. Even when there's no market for them, that resulted in excessive production, and actually it's a boom for the world that you can enjoy industrial products at such a low price. Without China, you will have to pay twice as much for an iPhone or a cell phone.
I'm not sure actually that I will agree with Francis that it's nice to disagree a bit, that is overproduction everywhere. It is a good argument to use when you are really worried about losing market share. And I think there are a lot of people very worried about that in Europe. They see what has happened in some other industries such as solar panels and that of course, I mean, we can just see the numbers. It's China is so dominating the world for that. So when you look at it, clearly, China's always had a very dynamic, very big, a very innovative industry and capabilities in many sectors. And you look at for electric vehicles, they're absolutely. I mean, they are the champions. So I think the price war about electric vehicles is completely unwinnable, and innovation as well. The war is completely unwinnable. But then again, let's not forget that a lot of the car exports from China to Europe are not only Chinese brands; they also basically European car manufacturers that have set their facilities in China for both the domestic market but also for re-export. So it is very tricky, and I think it's going to be increasingly in focus because it's got so much to do with jobs and the risk of losing jobs at a time when we already have a number of basically challenging outlook in terms of job creation.
This electric vehicle price war, Francis, it's just going to get worse, isn't it? Because we heard yesterday NIO was saying it's going to launch now a low-priced brand for about $34,000. We had BYD saying yesterday that it is aiming to have a leading position in Europe's EV market by 2030. This is clearly not what Ursula von der Leyen wanted to hear. But and we had Toyota, didn't we, saying they're going to have to try and do something that's going to be a game changer for them to compete with these Chinese EV makers because they're falling behind. This is really becoming a big issue, isn't it?
Yeah, definitely. Actually, Chinese EV manufacturers have a head start, I think 2 or 3 years head start. And the important thing is that they dominated the lithium battery market. 60% of the lithium batteries are made by Chinese manufacturers, and also 60% of the nickel, lithium, and cobalt mines are controlled by Chinese companies. So it is this vertical integration that's driving the prices down. So other than the Tesla, I don't think any other car manufacturer in the world can compete with Chinese EV manufacturers.
Even Tesla's struggling, isn't it? I mean, it's had to join in the price war as well.
Yeah, that's right. They have a much higher cost structure.
Karine, let me ask you about President Xi's visit to Hungary. This was interesting. He hailed yesterday Hungary as one of Beijing's most important strategic partners. He said China and Hungary have upgraded their relationship to what he calls an all-weather, comprehensive strategic partnership for the new era. And he said our bilateral relationship is at the best it has ever been in our history. We're going to do our utmost to guide the relationship to a golden pathway. And he was also talking about helping with economic, trade and financial cooperation. He talked about the Belgrade-Budapest railway and other key infrastructure projects. Now, analysts are saying that only Russia has ties with China that are described as a comprehensive strategic partnership. So, Karine, what do you make of this? Is what's going on here?
Well, of course, I think nobody's surprised to hear about this overly positive statement from both leaders. I guess that's the reason. That's one of the reasons he wanted to go to Hungary, obviously, because if you look at from a perspective of all the EU countries, the new, a place like Hungary is a place where Chinese are much more welcome, where there's much less questions about anything such as dumping or human rights or democratic rights and everything. So clearly it's quite important. Hungary has already now for quite a few years been really the beacon for Chinese investments. In 2023, Hungary was one of the top recipients of FDI, $13 billion, of which the larger part was actually coming from Chinese companies, including CATL, the leading battery producer, and now BYD as well, announcing the plans for a factory which by 2026 will produce up to, I think, 300,000 cars. When you consider how much people were worried about seeing this first cargo transport ship from BYD a couple of months earlier this year coming to Germany with 3,000 cars, and well, it's 100 times more than that every year that will be produced out of Hungary. So clearly, it's interesting. In a way, of course, you do understand why wouldn't Chinese take the opportunity of, first of all, going into a country where, as we said, there is less questioning about a number of things that the Chinese don't want to talk about. Secondly, Central and Eastern Europe still remains a place where the labor cost is cheaper. It can be a third or half of the labor cost of Western Europe. I was in Poland myself just 3 weeks ago, and is actually, and there is growth, not necessarily that much actually in Hungary, but there is growth, and so it is interesting. They have strong industrial base. They have all the key elements of a strong supply chain for the car manufacturing, and it makes sense. So we have a situation today that, unfortunately, just like Hungary is known in Europe and around the world as one of the countries with where you can basically see. You've been seeing now since 2010, since Prime Minister Orban was elected, democratic backsliding, and it is, of course, worth monitoring whatever is going on between China and Hungary. Just a last comment on you were just mentioning the high-speed rail. Budapest, Belgrade today, it's only 320 kilometers. It takes 8 hours by train. So clearly, I understand why they are very happy to get the high-speed train, which will get them to, as fast as we are used to in the region when we travel in China. Who would be against it? I think it's, yeah.
And while it's fair to say Hungary is probably the EU country with the closest ties to China, Serbia's probably the non-EU country with the closest ties to China as well, isn't it? They've just signed a new trade deal, which is going to take in effect on July the 1st. It seems that these are the two countries where President Xi wants to focus his attentions.
Yeah. So there's this thing called 16+1. So that was a coalition of 16 countries from Central and Eastern Europe getting together towards and with, for a partnership with China. And the number now is much lower than 16 for sure, and especially with the Baltic states, but even Poland, and that has a lot to do with, of course, geopolitics and the war in Ukraine, where a number of these countries are actually really irritated and annoyed by the fact that China is not showing a stronger voice against what's going on in Ukraine. So there is a lot of security-related matters, I think, in this. But this month we are celebrating. 10 days ago it was the 20th anniversary of the EU entry of countries such as Hungary, the Baltic state, Poland, and so forth. So it's an anniversary month. And of course, it's kind of interesting to see that's the month when Hungary is hosting President Xi.
Do you think, Francis, there was as an element of mischievousness in President Xi's tour here in selecting countries like Hungary and Serbia? Is he trying to drive a wedge between them and the EU and maybe even the US?
Well, of course, you only go to the country where you are welcome. President Xi will not go to America because he will be met by protesters. You don't see protesters in Hungary. So it's only natural. And certainly Hungary is the beachhead for Chinese investment. So if the EU wants to ban Chinese-made EVs, then BYD will establish a plant, a factory in Hungary to circumvent that.
And what about France? I mean, France wants investment in electric vehicles and batteries as well. It's also courting companies like BYD. But it was very noticeable also at the same time, President Macron was very careful to make sure that there was no split between what he was saying and Ursula von der Leyen was saying. I mean, she was there, I think, really to give the tough message, wasn't it? That we're going to protect our companies, we're going to protect our economies in Europe, we need protection from Chinese imports. He didn't really deviate from that message.
I think here is again need to remember the timing of his visit with the EU elections coming up, where Ursula von der Leyen she has a lot to win in Europe by being tough against China, and so that was actually easier for Macron to have her by his side, to be the one to deliver this kind of message, which I personally think is maybe more for the domestic or EU audience than actually for China, because Xi Jinping was probably expecting it anyway. And
Do you think the EU is going to follow up these words with actions? We've got that investigation going on into Chinese electric vehicles and overproduction and subsidies there. That could come to a conclusion maybe even this month, and potentially we could see subsidies on Chinese electric vehicles by next month. Do you think the EU...
not subsidies, but tariffs.
Tariffs on Chinese exports. Do you think the EU is all prepared to go and do this?
Yeah, I think they will. Because it's very much, again, supporting the political agenda, and probably the Chinese, I would say are quite ready for that anyway. So, we're back to the conversation we had in the beginning of the podcast about the exports of China towards which markets. If the US is getting tougher, US is already tougher. If Europe gets tougher, then they have the rest of the world. And there is a lot there that still wants to consume and purchase Chinese stuff. So. I'm not worried necessarily actually for Chinese exporters. I think what is a bit sad, of course, is the fact that, for instance, these electric vehicles or solar panels are all things that we do need acutely to help us for the green transition. So it's very sad in a way that this climate agenda, which is again absolutely crucial to humanity, is being derailed and delayed by geopolitical tensions and trade tensions and so forth. And we have the US elections coming up that could also, of course, jumble everything.
I find it hard to believe the EU's argument that China is producing more electric vehicles than can possibly be absorbed. I would have thought there must be plenty of demand for electric vehicles from everyone, not just China, surely.
Yeah, absolutely. I mean, of course, today China is the leader. I was in Beijing last week, and it's mind blowing to see the number of electric vehicles in the streets. Beijing has become quieter because of that, actually, and we have the same obviously here across the border in Shenzhen and whole of Guangdong. Whereas, so when you go out, I mean, except Norway, in Europe, you still have a much lower penetration, and US hardly any. So clearly, there are a lot of markets where we want to see more electric vehicles, and it's going to happen.
Mm-hmm. Francis, let me get some final thoughts from you. Do you think we're heading for another leg of the trade war, this time between the EU and China?
Well, the trade will never stop, actually.
But this will be another sort of extension of it.
It has been there since the 70s where you had the multi-fiber agreement. So now they don't worry about shirts and pajamas. Now they worry about EV. So the problem is the difference between the income of Western Europe, US, and China. So China can always make a product cheaper. So
there's just no chance of competing with that, really, is there?
That's right.
But that's how economics work, isn't it? That's how competitive advantages work. You produce the things that you're good at and that you can do cost effectively, and you import the things that someone else is better at doing than you. Surely this is all fair, isn't it?
Yeah, this is economics.
and the Chinese are excellent at it because they are the factory of the world, and one of the reasons they are the factory of the world is not only because it's one of the largest country in terms, of course, of population, so they've had a huge labor force and everything, but it's because a lot of European and developed economies, I would say, factories or companies have decided years ago to relocate their production capabilities. So, and the Chinese have learned a lot from that. So it's also somewhat, you cannot say that it's this what we're seeing today is a consequence and an effect of decisions that were made in the past by European companies. By American companies.
Okay, well, thank you very much. Have a great weekend. You heard there Karine Hirn, who's partner and chief sustainability officer at East Capital Group, and Francis Lun, who is the CEO of GEO Securities. I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Good morning, Peter.
The Reserve Bank of Australia kept interest rates on hold, but it did raise its short-term inflation forecast. The RBA had been tipped to start cutting rates by the end of the year. Toby, do you think they're on track for that still, or do they have a bit of an inflation problem?
I don't know if they've got necessarily an inflation problem. They've probably got similar to what we're seeing in the last month or so around the developed economies, the sort of stickiness to the number and a slowing in velocity of any decline. So as you mentioned, revised the forecast to a 3.8% on inflation versus original 3.3. Target, as you know, with the Reserve Bank's 2 to 3%, so they're well above that, which means rates are on hold. And difference between the Australian Reserve Bank and others around the world have been saying that they've always been on the neither ruling in or out, a cut or a hike. And some of the press during the week was that it was a sense that the Reserve Bank was saying, I hope we don't have to raise rates, but it's still potentially there. So it's an interesting dilemma. I think inflation is sticky as it is around, but and would suggest that rate cuts are off the agenda for the time being.
It's very similar to the US, isn't it? As you said, they've got sticky inflation like the US has. Although they seem to be, Michelle Bullock seems to be taking a sort of a more hawkish stance on that, whereas Jerome Powell has been quite clear to rule out any chance of a rate hike. Do you get the impression that the RBA is being a little bit more hawkish about this?
Yeah, they've got a little bit more, a couple of things on that. Yes, I think inflation's a slightly higher in relative sense, and the trajectory's a bit more persistent than it is in the US. I think there is concern about the impact of government policy, whether on immigration, whether it be on government spending, having an inflationary impact. And so we'll see the budget next week. Federal budget comes out next week. It's going to be quite significant in terms of, giving the RBA an indication of how the government's managing its spending and to try to reduce the impact of inflation. And also, of course, Australian interest rates are a bit lower relative to the US, about 100 basis points. So there's a little bit more room to move, although I put a caveat on that. The reason why we're probably 100 basis points cheaper is that home mortgages, home loans are variable predominantly in Australia, which means the impact of higher rates is much more significant than in the US. So a couple of factors at play, but on balance, you would say that the RBA are a little more hawkish than the Fed.
And on the economic side, we did have some data, didn't we, on retail sales. They fell for the first time in 6 quarters.
Yeah, and the consumer is definitely tightening their belts. There's no question about that. The labour market still stays pretty tight, although, again, we're seeing some softness starting to appear anecdotally across the various sectors. One thing that's changed, that's sort of disguising it a little bit, I guess, is the population growth. So even if you're looking at 0.1% growth in retail sales, if you factor that we've actually had a 2% increase in the population, it's actually a lot softer than it would appear at headline level. So there is definitely an impact of the higher rates, and the cost of living has risen such that we are seeing a reduction in consumer spending.
And what do you make of the Bank of England? They signalled that they could cut rates this summer if inflation stays low. They left interest rates at a 16-year high of 5.25%. But BOE Governor Andrew Bailey was optimistic that things are moving in the right direction. You sort of almost get the impression with the Bank of England, they're almost itching to cut rates, aren't they? But they just can't quite press the button yet.
Yeah, I was reading some of the reports. They got cold feet. The voting was sort of 2 out of 9 voted for the cut, so 7, clear majority, were suggesting on hold. I suspect they're trying to align themselves a little bit with what the ECB might do in the mid-June meeting. I think the next meeting for the BOE, should I say, is June 20, and I suspect they're hoping that the ECB might cut rates, which gives them a bit of air cover to do it themselves. I think you're right; they want to do it, but they are concerned about that stickiness in the inflation story. And
there's a lot of political connotations here as well, aren't they? Because it's obviously general election year in the UK. Rishi Sunak's hoping to convince voters that the UK economy has sort of turned the corner from the cost of living crisis. So I suppose the BOE, even though it's apolitical, must certainly be aware of that.
Yeah, so the election timing hasn't been called, I guess. But that's clearly a factor that once an election's called and the period's in them, the central bank tends to, put its tools down and wait till that's over for fear of being considered political. I suspect that if things go according to what the ECB were reflecting, a June 20 cut's probably an option. And as we've said previously, Europe is softening much more recessionary environment potentially in Europe than in the US. So it's highly likely that Europe will cut rates ahead of the US.
But they are sort of moving together, aren't they? The Swiss National Bank has already cut rates earlier this year. We had the Swedish Riksbank cut rates this week, and now we've got the BOE talking quite dovishly, and also the ECB as well. It looks like they may move pretty well. Well, 2 of them have already, but the other 2 may well move ahead of the Fed.
Yeah, I think it's a reflection of where European economic growth is, and clearly softer than what the US is. Certainly an impact to consumers not as robust in Europe as it is in the US. So that would indicate that the ECB and other central banks are likely to move ahead of any move by the Fed.
And what about the Bank of Japan? We had the summary of opinions from the Bank of Japan's last monetary policy meeting. They were in that flagging upside risks to inflation and saying that they are ready to adjust monetary policy, but there's also high uncertainty about economic activity and inflation. Very hard to know what really the Bank of Japan is going to do or can do at the moment.
It's almost a case of careful what you wish for. It's taken them a long time to get inflation back into the economy, to give them that velocity. That they've had a deflationary story for decades. So in that sense, they've been really quite keen to keep policy accommodative, to get that velocity that they've needed. Now they're in that situation where they've got what they wished for, and now they've got to somehow maintain some control around it, which is the most difficult thing. And interestingly, one of the points that they started to talk about a more hawkish stance was in order to influence the currency, and the yen, as we know, has been depreciating quite sharply. So, and also I think they reflected on a reduction in bond purchases, so some quantitative tightening as well. So the language, I think, has become much more hawkish than it has been. And that's a reflection of the reality, I think, both a combination of inflation but also the yen depreciation and trying to find a way of turning that around a little.
What was interesting was the data that was out this week that in many ways just increases the Bank of Japan's anguish. Average cash earnings in Japan increased by 0.6% year on year, slowing for the second straight month. But more importantly, the country's nominal wage growth is now behind the inflation rate. So basically inflation is wiping out the benefits of these wage increases. That's been the case now for 24 straight months. Japan's real wages are down. This also puts the Bank of Japan in a bit of a dilemma, doesn't it?
Yeah, and governments as well in relation to trying to get some real wage growth into the economy, at the same time trying to not spike inflation. So it's not a phenomenon that's unique. As I said, I think Japan's probably had a long period of low growth, low inflation, and it's looking for some acceleration. So there's an erring on the side of letting things run a bit more. Interestingly, that doesn't have a very good impact on the currency, and so that's why I was noting in at least in the dialogue now that they're starting to try to find ways of stalling the depreciation in the yen by using more hawkish language. But I suspect that they don't want to have to tighten things up too much.
How big a problem is this slide in the yen? It's slipping again, isn't it? It's at 155.5 at the moment, not quite the 160 it got to a couple of weeks ago, but the yen's also sliding against a lot of other Asian currencies as well. It's down about 8% against the offshore renminbi this year. It's at the weakest level versus the Korean won since 2008. It's at a 31-year low against the Taiwan dollar, and this in turn is then dragging other Asian currencies lower against the dollar. It's sort of becoming a sort of a vicious circle, isn't it?
Yeah, and the fact that, we've said this before, as soon as central banks and governments start talking about it, it makes it even worse. So when you start talking about intervention, or when you start talking about strategies and policies to try to create a turn around the depreciation of currency, often markets tend to drive it even further from a depreciating perspective. And I think it's not a unique situation, as you see, but Japan is one economy that probably, with policy so accommodative, that on a relative basis the currency is going to be impacted. So it's an interesting dilemma that they're in. I don't think it's going to change in the short term, short of them being much more aggressive. And even if they become more aggressive on rates, in order to try to create some sort of circuit breaker, if you will, I think it actually could have the opposite effect.
And is it a problem for other Asian central banks? Because, as I said earlier, it's dragging other currencies lower against the dollar as well, isn't it? And then we see, like, Bank of Indonesia having to raise rates to try and support the currency.
Yeah, so I mean, look, there's good things and bad things with depreciation. You get obviously exports cheaper, but then you've got a situation where demand might not be the same in global economies. So the weaker currency doesn't necessarily lead to better results on the export side. So, I think at some point, central banks and governments have to respond, and Indonesia's doing it, other countries trying to do it, but often it has actually a negative impact, because people see it as a panic. Whenever central banks and or governments want to intervene in currency markets.
Now, we had some interesting data from the US as well. US jobless claims last week reached their highest level since August. They hit an 8-month high, up 22,000. What's the significance of this, and particularly in terms of the Fed and when it may cut interest rates?
Well, I think the market liked it. So that not from a social perspective, but purely from a data perspective, because it puts the potential for a rate cut back on in terms of the dot plot that previously been pushed out again from the recent inflation data. It's one of the key elements of the story that hasn't necessarily thrown through to a normal economic model. When you tighten rates, you should see the labour market soften and unemployment go up. So whenever you see data that's actually affirming that outcome, it's seen as a positive, and we haven't seen a lot of that. The labour market's been particularly tight for some period, despite the higher interest rates. So anything in this jobless claim is is a significant enough turn to see the equity markets rally and the bond market, bonds also rally on the back of it. So I think it's significant to the extent that it may just bring back that dot plot closer to September rather than pushed out further.
It seems nothing can stop this rise in US equities, can it? We've had the Dow up 7 days in a row now, the S&P 500 less than 1% away from an all-time high. It seems that they're pricing in a Goldilocks scenario here. Do you think this rally can continue?
Yeah, and it's somewhat surprising, but I think it reflects a couple of things. I think the bond market, bond yields have dropped away from that 5% area where I think we spoke a few weeks ago about that being an issue, and so So the heat's come out of the bond market a little bit. That's a positive impact on equities. And then the corporate earnings season, albeit I think a bit more volatile than we've seen, we're still producing some pretty good results on the corporates, particularly in the large corporates. So in that sense, there's an underlying strength to corporate America. There is yet to be significant dislocation from credit markets. Bond yields have come back off. So on that basis, the equity investors are going, I quite like what I see. There is still an argument for the soft landing or the no landing scenario. I think I wouldn't say there's reason to be bullish. It's just that people are comfortable to invest in large cap stocks when they're producing pretty good earnings, and there's a potential interest rate cut down the track.
And let me finally get your thoughts on President Xi Jinping in Europe, in France, Serbia and Hungary this week. Did he do enough, do you think, on that trip to avert the possibility of a trade war between the EU and China, particularly on this issue of electric vehicles and overproduction?
Yeah, I don't think so. I think, to me, it was a bit like a creditor's visit to Serbia and Hungary. They invested a lot of money in there, so they're checking on their credit risk in those two countries. I suspect there's a bit of that. The politics of it played out, I guess, reasonably positive because he managed to spend time with France, as opposed to just two countries within the European Union that are supporting China. So in that sense, I think it was good, but I still think there's a lot of concern around the issues of dumping, for want of a better expression, in some sectors into the European economy and how trade is impacted, and more broadly the geopolitical situation where there's still the Ukraine conflict still rides high in European sentiment, and China being a supporter of Russia still plays out. So I suspect nothing major from the large European economies, but obviously a positive spin from his visits to Serbia and Hungary.
Toby, thank you very much indeed, and have a great weekend. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you very much for listening this morning and this week. Don't forget to take a look at my daily Asian newsletter, which has the latest business and finance news from the Asia Pacific region. You'll find it at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and John Schofield, Managing Director of Tempest Investments. And providing a view on mainland China is China specialist and author Mark O'Neill. Have a good weekend.
Money Talk.